the Pramerica Life Super Investment Plan the smart ULIP for building wealth or just another hybrid product with complicated trade-offs? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. So this is a unit-linked, non-participating individual savings life insurance plan, and some of the key features of the policy are: you get to enjoy the dual advantage of life cover and financial security for your family against life's uncertainties. You can also achieve your life goals by selecting from 3 flexible plan options, and you can choose between 2 investment strategies and 6 fund options tailored to your investment preferences, and there are no premium allocation charges, which means you can enjoy 100% allocation of your premiums in all policy years, and you also earn persistency additions and persistency boosters at predefined intervals during the policy term, and you can meet your recurring financial needs conveniently through the systematic withdrawal facility, and you can also avail tax benefits on your premiums paid and benefits received as per the prevailing tax laws. So these are some of the key features of the policy, and there are benefits like death benefit, maturity benefit, and persistency units and persistency boosters. So all these benefits will differ based on the plan option you have opted for. Another benefit is return of mortality and return of waiver of premium charges. So as a unit link policy, it's previously mentioned that there are charges present, but there are some charges not present. So the charges present are policy administration charge, mortality charge, waiver of premium charges, fund management charge, and discontinuance charges. So all these charges apply throughout the policy term, thereby reducing the portion of your premium that is actually invested. So over time, this leads to lower compounding benefits and can significantly impact your long-term wealth accumulation. Even if they return some of the charges at the end of the policy term, the time value of the money is lost here. So we need to consider this as a drawback only. So some of the advantages are: they return your mortality and waiver of premium charges on the survival of the life assured till the end of the policy term, and you can enjoy unlimited fund switches and premium redirections within the defined portfolio strategy to capitalize on the market movements, and you have the option to pay additional top-up premium over and above your regular premium to enhance your investment corpus. Partial withdrawals are allowed only after completing 5 policy years, which is the lock-in period for this policy, and you can access the systematic withdrawal option, which is an automated partial withdrawal facility available anytime from the 10th policy year onward. So the settlement option also allows you to receive your maturity benefit as a structured payout over a period of up to 5 years. So these are some of the advantages of this policy. So some of the drawbacks of the policy are: there is no loan facility available under it, and after deducting applicable charges, only then your net premium is invested. So the life cover offered may also be inadequate to meet your family's financial needs, and this plan comes with a mandatory 5-year lock-in period. So these are some of the disadvantages that you need to keep in your mind before deciding to invest in this policy. So now, as we have a basic idea about this policy, let us move on to the analysis part of the video, where we are going to conduct an IRR analysis based on the policy brochure's benefit illustration to help us make a more informed decision. If you want to know more about certain aspects of the policy in detail, you can refer to the policy brochure. So now let us assume, for calculation purpose, that a 35-year-old male has purchased this plan with a sum assured of 10 lakh, opting for a 20-year policy term and a 10-year premium payment term, paying 1 lakh annually under the wealth builder option. So if he pays all the premiums as scheduled, he will receive the fund value, which includes his boosters and return of charges as the maturity benefit. So in the policy brochure example, they have assumed a future investment return of 4 and 8% per annum, but these returns are not guaranteed and they should not be seen as a fixed projection. This is just to show you how this policy can perform at worst and best case scenarios as an example scenario. So at a 4% return scenario, the fund value is projected at 14.43 lakhs, yielding an IRR of 2.38% as per the policy's maturity calculator. At an 8% return scenario, the fund value is projected at 26.19 lakhs with an IRR of 6.31% as per the policy's maturity calculator. So even at the higher assumed rate, the returns do not appear proportionate to the risk associated with a market-linked product. So typically, investors expect equity-linked investments to generate higher returns that comfortably outpace inflation over the long term. So the potential return from this policy is more in line with debt instruments, making it difficult to justify this plan as a true equity investment option within a diversified portfolio. So now, as we have an idea about how this policy is not giving us the desirable outcome that we need, let us move on to a comparative analysis where we are going to invest in insurance and investments separately just to see whether that can give us more efficient returns. So here, for life cover purpose, we have taken up a pure term life insurance policy. So we are going to use the same parameters from the earlier example for a more fair comparison. So for the life cover policy, we have taken up for a sum assured of 10 lakhs, a 20-year term and a 10-year premium payment period, which cost us approximately 7,500 rupees annually. So this allows you to save 92,500 rupees per year, which can be invested separately. So depending on your risk appetite, this amount can be directed towards either equity, which is high risk, or debt, which is low risk options. So for this analysis here, we are going to consider both the alternatives. A public provident fund PPF representing the debt option and an equity mutual fund represents the equity option. So in the case of PPF, a minimum monthly contribution of 500 rupees is required for 15 years. Since the premium payment term here is 10 years, adjustments are made to align the contribution period. At maturity, the PPF corpus amounts to 27.29 lakhs, generating an IRR of 6.58%. Interestingly, this is on par with the 8% return scenario of the Pramerica policy, even though PPF is a low-risk debt instrument. On the other hand, investing the same 92,500 in an equity mutual fund results in a fund value of 56.46 lakhs after 20 years. And even after accounting for capital gains tax, the post-tax value comes to 50.72 lakhs, translating to an IRR of 10.74%. And if you have any doubts regarding how we have calculated the tax for equity mutual fund, we have presented a small tabular column for that in the screen before you, which you can pause and see. So clearly, these returns are substantially higher than those offered by the Pramerica policy and comfortably beat inflation, enabling faster wealth accumulation over time. In conclusion, separating insurance and investment by opting for a pure term plan and investing independently proves to be a more efficient and rewarding strategy. So what is the final verdict then? Is investing in the Pramerica Life Super investment plan worth it or not? So this is essentially a unit-linked insurance policy with 3 variants offering slight variations in features. So the Wealth Builder option focuses on accumulating a sizable corpus, the Inheritance Builder provides whole life protection, and the Dream Builder plan ensures policy continuity even after the policyholder's demise. Across all 3 variants, the maturity benefit comprises fund value, boosters, and return of charges. However, an analysis of the internal rate of return IRR indicates that the plan's performance is not compelling for long-term investors. So the returns are not proportionate to the level of market risk undertaken by the policyholder, and this policy also has a high agent commission. So comparable market-linked instruments such as mutual funds generally offer superior returns and liquidity. So if your goal is wealth accumulation, it is advisable to avoid ULIP. Your equity portfolio should consist of high-yielding investment aligned with your goals. So the more prudent approach is to opt for a pure term life insurance policy to ensure adequate financial protection and build a separate investment portfolio based on your risk appetite, financial goals, and time horizon. In short, never combine insurance and investment.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.